You might be at a point in your life that you are faced with a decision whether to take a normal home loan or a building loan, right? And you don't know which one to take, right? In this video, we're going to break down what is a home loan and what is a building loan, and between the two, which one is much cheaper than the other. But before we get to that, as you know, in this channel, we talk all things real estate, all things personal finance, so that you are the driver of your financial institution and not just the passenger. So let's get to it, shall we? So what is a home loan really? So if you are looking at buying a newly built house, which is a development house or a pre-owned property, right? But you do not really have the funds, right, to purchase that property, you will go to the bank and apply what is called a home loan, right? So a home loan, it's basically the money from the bank, of which you need to pay it back in a certain period of time with interest. That's basically what it is, but it's linked to the property that you are buying into. And you need to prove that you have been approved to the seller, normally within 30 days. But in some cases, you are given 45 days to get that approval. Right? So normally the home loan term in which you should repay that home loan will be 20 years. But in some cases, in some banks, allows for 20 years, for 25 years and 30 years. So take in mind that the longer your home loan will be, the lesser your installment you will pay at this moment in time. But if maybe you take 20 years, compared to the 25 years and 30 years, your home loan installment on a monthly basis will be much cheaper. Expensive if it's shorter. If it's 15 years or 10 years, then the home loan installment will be much more expensive. Makes sense, right? Okay. But also, in terms of the National Credit Act, right, the bank can only give you what you can afford. They cannot give you what you cannot afford, because it will lead you to be over indebted, and that is an offense by the bank. So that's why if the bank, when they look at your credit record, they see that you don't qualify, they will decline you, right? And that's why it's ideal that maybe before you start on this process, you should actually do a pre-approval, right? So that you know how much you qualify for, right? So that when you're looking for your house, you look according to the budget that you qualify for, right? So that you don't look at the houses that are here and then you qualify for here and then your expectation has been reached, right? So if you have not already subscribed to this channel, can you please subscribe to this channel so that this information can be shared with other viewers as well, right? The more you subscribe, the more you like, the more you share, the better for other people out there that need this information, right? Because this information, I believe, it's so much value adding to so many people, right? Okay, so what is actually needed to be apply on a home loan, right? Normally they will need your 3 months bank statement, your 3 months pay slips, your copy of IDs. But in cases where you work overtime, maybe you've worked overtime in the last 3 months, then they will need your 6 months bank statement, 6 months pay slips, right? And then of course your copy of ID. But you will need also offer to purchase document, which is basically an agreement between a seller and a buyer that you guys have agreed to sell and buy a property to each other at a certain price, and there will be some certain condition of which an agent will really explain to you how that works, right? But another thing is that your credit record will be checked, because the bank want to actually see that you are a risk to them or not, right? If you are a risk, then they will give you a higher interest rate. If you are not a risk, then they will give you a lower interest rate. So you get the benefits if you are a low risk, right? There's so many videos that I've made in terms of how to actually improve your credit score so that you become a lower risk person to the bank. So I'll put the link of those videos on the description below, so you can just go and refer to them and find out how you can actually make sure that your credit record is on a level where you are not a risk to the bank and they don't charge you a high interest rate, right? And then also in terms of the interest, on a normal home loan they can charge you two types of interest rate, right? But you need to choose between the two. So they can charge you what you call a fixed interest rate or a variable interest rate. A fixed interest rate means that there's a what you call a prime lending rate, right? From the prime lending rate, based on how much of a risk you are, they will give you maybe, let's say, prime minus 1 or prime plus 1, right? So that interest rate that they give you, right? If it's a fixed interest rate, it means if the repo rate or the prime is changing, your interest rate doesn't change. But what you must take note is that fixed interest rate will be much more expensive than a variable interest rate at that point, right? And then it does not change throughout the term, the agreed term, so it doesn't change. But a variable interest rate, whenever the prime lending rate changes, whether it's going up, whether it's going down, it also changes. So the thing here is that on a variable interest rate, sometimes you might not be able to budget properly because you cannot really foresee when it's gonna go, right? But on a fixed interest rate, you are able to budget properly on what your installment will be, right? Because this interest rate determine whether your installment will change or not, right? So that's what it basically mean. And then the interest is calculated on a daily basis, but is debited on a monthly basis. What it means is that on the amount that you owe, interest is calculated daily, but the bank only takes the installment on a monthly basis. Right? So in summary, that's just about in terms of home loan, because I don't want to prolong it because you can see that the video is already long by itself now. So let's get to a building loan. So how does a building loan works, right? So a building loan is when you decide to buy a plot or a vacant stand and build a home, right? This gives you, a home of your own image, right? So I always tell people, because most people don't understand that when you are going to view a already pre-owned house, right, you cannot expect that house to meet 100% of your requirements, because when somebody else was building that house was not thinking of you, he was thinking of his requirements. So if you decide to go to a pre-owned property, at least 80% of your requirements, 70 to 80% of your requirements must be met. The rest you can do it over time. But a building loan offers you that opportunity to put 100% of your requirements into it. So this is what it means, right? So you can use a building loan if you buy a vacant land or a stand and you want to build your dream house in there, or you are currently in an existing house that you don't like for some reason or another, then you're making alteration on that property, you can take a building loan for that, right? You understand now how a building loan is working, right? And then, but when you take a building loan from the bank, right, the bank doesn't pay the money directly to you. They pay to the contractor, right? And they don't pay it in full. They actually pay in phases. So let's say there's foundation phase. Then you will do foundation phase and complete. Once it's completed and it's acceptable, it's satisfactory, it meets all the requirements, only then they will pay for that phase. Then you go for another phase, just like that. So the bank pays in phases. So what do you need to apply for a building loan? All right. So all the documents that I said are needed for a home loan is all the documents that you will need also for a building loan. But there's more documents that are needed on a building loan, right? On a building loan, you will need approved building plans, right? And site plans on that area and how you want to build the property, right? You will need also a building contract and schedule of the finishes from your builder. You will need a proof that the builder that you are using or the contractor that you're using has been registered with the NHBRC, right? The NHBRC. If the builder you want to use is not approved or is not registered with the NHBRC, forget about it. They're not going to approve your application for a building loan, right? And then also, you need to get an all-risk insurance policy for the construction, right? And you need to get a waiver of builder's lien in favor of the bank, right? But what you need to take note is that in some cases, you will be required to pay a deposit. At least 10% of deposit will be needed to cover the cost of the build to finance any shortfall between the loan granted by the bank and the eventual cost of the completed home, right? Whereas on a home loan side, you are not really mandated to get that deposit. It just only depends on you if you have that deposit you want to pay, or if you you have an affordability issue and they give you a lower LTV, right? Which is a low loan to value ratio, right? So then let's get to the big question of the day, right? Which one is more expensive, right? Or which one is better, right? So in terms of which one is better, I cannot really say which one is really better. I've given you the facts. You choose which one works better for you, right? Whether a home loan or whether the building loan. But it is for you to decide. It is for you to see what is your own requirements, what is your own circumstances. But in terms of being expensive, a building loan is more expensive. But on the other hand, it's more expensive, but in a long run, you will save on maintenance, on renovation, and then transfer fees, right? So let me end it here for today. Guys, don't forget to subscribe. Don't forget to share with your friends and family. Cheers. I'll see you on the next one.